In the US, orders for durable goods dropped 1.2% for September in data out yesterday, as manufacturers struggle with economic weakness in key export markets and a stronger dollar. Now we look to upcoming GDP growth data and today's interest rate decision to get the full picture of the US economy. I'm joined now by Deputy Chief US Macro Strategist at TD Securities, Millan Mulraine. So Millan, US durable goods data out yesterday brought to light the diverging nature between the US service sector and manufacturers, which continue to drag due to global uncertainties. Can we expect this weakness to continue?
Well, I think what we've seen is a certain trend of the weakening pattern, not only to the part of the economy that's exposed to the global economy, mostly manufacturing sector, and also the ones that's exposed to energy sector. But I think what we're seeing now is an infiltration of that weakness into the broader economy, and that is of a bit of concern. We've seen that reflected more generally in the slowing growth momentum. I think to some extent one considers this durable goods report as straddling both. Yes, there's a huge manufacturing component, but to the extent that the manufacturing activity also reflects domestic demand, I think what this is telling me is that that slowing is particularly germane, and it certainly is an indication that the service sector is also being affected by it. We did see a similar weakness in service sector indicators. That's not inconsistent with what we've seen in confidence, both business and consumer confidence, which has ebbed somewhat over the past few months.
Now, with this durable goods data, doubts have been cast about the economy's performance during the third quarter. We'll be getting a broad look on Thursday of the US's economic growth for that time. Are we likely to see another disappointing piece of data?
Yeah, no, I think so, and this will be the culmination of all of the weakness that we've seen in the array of economic indicators over the past 2 or 3 months. This is GDP for Q3, which is amalgam of all these indicators. We will see a dramatic fall off in the pace of growth momentum from a fairly buoyant and respectable 3.9% in Q2 to a far more subdued 1.5 range that we think we will get for Q3. I think much of that is due to inventory correction that will be transitory, and we expect that to give way to a fairly modest rebound in the coming quarters. But I think if you dig beneath that report, what you would see is some underlying strength, some residual underlying strength in domestic economic activity. Consumer spending should be fairly buoyant. It goes to your earlier point about the service sector remaining fairly buoyant, though we are beginning to see some signs of weakness. We do know, at least for Q3, that the underlying economy did hold up quite well. We tend to use domestic demand for an indication of that, and that should be quite good. Where the weakness would be in inventory, which I think is an indication of weaker demand in the future, and also the external sector, which is the trade sector. That should be a huge drag on economic activity. So, in effect, if I were to summarize that report that we expect tomorrow, I think what it would show us is that growth momentum is shifting, more so because of external activity and weak external demand, the strong dollar, low energy prices. But there is some residual weakness that's beginning to show up in the domestic economy, though that remained fairly buoyant during Q3.
Now later today we have the Fed's October meeting. No move in interest rates is expected, but do you think we'll see some indicators of what their next move is?
Yeah, I think so. I think for a market that is a bit wary about the Fed's desire to start tightening policy this year, no news is bad news in the sense that you would want the Fed to start showing its hands as to what it wants to do this year, whether it still remains committed or it believes that the data is still consistent with them raising rates this year. We don't think it is. In fact, our call is for the Fed to hold rates until March next year, when they'll get a much clearer picture on where the economy is heading and get a much better accounting on global growth. If that is the case, then we do think that the Fed will start providing some signal. It wouldn't be a clear signal in the sense that they would still want to keep the market guessing to some extent as to whether or not they will go. They would continue to emphasize the data dependency, but they would start making some incremental steps away from wanting to tighten policy this year. I think one area of focus for us is the assessment on growth and the labor market. Both have started moving lower, and we expect that to be reflected in the statement. Particularly the growth characterization should move from moderate to modest. That would be an indication, in our view, that the Fed is giving a nod to the weakness that they're seeing in the economy more generally, and also the labor market activity should have some reference to it slowing. That again is consistent with the data. But overall, I think the risk assessment should still be intact. We should still have that reference to global development being a downside risk to both growth and inflation. While some of the uncertainty have abated over the past few weeks or since the September FOMC meeting, I think that there still is some lingering uncertainty, and there still is, in terms of the Fed's mind, some uncertainty about what the exact impact will be on the economy. That will take some time to play out.
That was Millan Mulraine from TD Securities with me there. Now, news on the Fed's October meeting will be out at 6 p.m. GMT this evening, which will definitely be worthwhile to keep an eye on. That's all from me. Bye for now.